Catherine Mealor covers United Community Banks as the managing director for KBW, and she's joining me now to talk more about this. Good morning.
Good morning.
It's so great to have you on the show this morning. So let's just dive into this conversation, shall we? So what do you think are the biggest factors impacting your outlook for United Community Banks?
So we love United Community. United Community is a high quality regional bank. As you said, they're about $27 billion in assets. They operate in really attractive markets across the Southeast. One thing we love about this company is they've got really high levels of capital, which is good in this market today. But also, good levels of profitability. Credit has been very benign for UCB, and so we think they're in a position to really be able to move into the offensive once we get in a better environment for regional banks.
Now, you probably heard a little bit earlier in the show that United Community Banks operates in the Southeast U.S., and we understand that we see its markets very attractive to many. So why do you think it's viewed so attractively to consumers?
Well, the Southeast typically has good demographics, right? There's job growth, and credit has remained very benign in these markets as well. But really, it's the ability to continue to grow, hire, take market share from other competitors, and that's really what typically drives a lot of the Southeastern banks to do well. M&A is something that I think is going to be a positive for a lot of the Southeastern banks as well, and we're starting to see a pickup in that activity, where I think UCB will be able to participate in that over the next couple of years.
And Catherine, what sort of growth opportunities do you see for United Community Banks when it comes to potential M&A?
So UCB is really good at buying smaller community banks within its markets. They don't typically do very large deals, but they do smaller tuck-in transactions that really fit into their business model well. And we would expect them to continue to do that. They're very good M&A executors. And so typically when they announce a transaction, they execute it well, and I think that's why the stock would perform well if they started to do M&A again over time.
Now, we'd be remiss if we didn't talk about the regional bank sector at large, especially after everything that has transpired last year. So what does the broader landscape look like now?
For banks, it's really all about the macro. We're watching the Fed. We're watching to ensure that we're going to get a soft landing, not a hard landing. The yield curve environment has been really challenging for banks. We're encouraged that the 210 curve is improving and flattening a little bit. The 3-month, 5-year is really what we need to not have inverted anymore. But one thing that's really important for banks that we think we saw this past quarter was we finally saw the bottom in net interest income, which is the greatest component of revenue for banks. We saw that for the banks this past quarter. We actually saw it for UCB in the first quarter. And so starting to see actual growth off of that bottom is going to be really important for this industry. Credit we're focused on and remains actually really strong. We've seen some modest moderation and normalization in credit, but nothing detrimental to the industry. And so, I think continuing to watch the economy, the Fed trajectory, an improving yield curve environment, and a position where we can actually grow EPS into 2010, and then maybe see a little bit of M&A. Those are all the signs that we're looking for regional banks to start to improve again.
And there's a lot of things that have been occurring right now in the current economic climate that we're in. Geopolitical situations unfolding overseas, and obviously these kind of things impact market volatility. So what sort of steps are regional banks taking to protect themselves from high levels of volatility?
Well, I think one on rates, I would say, I do think the banks are well positioned for a period of rate cuts. So, the last cycle we had, anytime you see just dramatic shifts in interest rates like we saw last year, it's really challenging for the banks. And so I think even some of the banks that were more asset sensitive coming into the last cycle are actually slightly liability sensitive now. So they're prepared for a lower rate environment. The biggest thing that I think is important in that volatility you said is that the Fed is moderate in how they cut rates. So if we see, and part of our economic baseline is that we assume the Fed cuts every other meeting, and that kind of moderate trajectory down, I think, is a good position for bank stocks.
Yeah, let's talk about the positioning a little bit more. So can you elaborate more on how favorable or unfavorable it is right now for regional banks and how they're exactly positioned compared to the larger national chains as the Fed is, like you said, likely ready to begin cutting rates later on this year?
It's going to be all about the ability to lower deposit cost. And so that's been the big challenge between the large banks, because the large banks had a lot of deposit share over the last year. And so I think it's the ability to lower deposit costs is going to be the biggest thing that we're going to be watching. And banks are really all over the board in how they're thinking about that. Some think they can cut aggressively when the Fed starts to cut. Some are being a little bit more muted in how they're thinking about that. But I think that's going to be the biggest thing to watch for banks as the Fed starts to cut.
And I want to talk a little bit more about the biggest trends right now that we are seeing in the sector, especially with the implementation of first-in-class technology and AI, Gen AI. Obviously, these are at the forefront of so many conversations, especially here on Wall Street. So talk to me right now about what you're seeing in the broader landscape.
Well, I think that is something that started really before, we had we had all of the trauma, I would say, of early 2023 with Silicon Valley. We'd already started to see a big investment in technology. And I would say that moment in time for our industry really accelerated that last year. And so now funding costs have kind of stabilized, so that's really good. And now we're kind of back into, now that we're seeing a greater trajectory of revenue growth, we're back into investing mode. And so I think, and that's where the large banks have an advantage, quite honestly. They've got more scale, they've got larger balance sheets, they're able to invest more in technology. And so that's the gap we're seeing between the large banks and the small banks. And that's one reason we think M&A is going to be really important in this next part of the cycle, is as banks continue to grow and compete with the large banks, they can build scale and be able to invest in the technology that allows them to compete effectively and continue to grow the deposit base.
Well, there is a lot to look out for. Thank you so much, Catherine, for joining us on NYSE TV Live this morning.
Great. Thank you for having me.
Absolutely.